If you have ever looked at a price chart and wondered whether it could tell you something useful, you were already thinking like a technical analyst. Technical analysis is one of the most widely used approaches in Forex trading. The core idea is straightforward. Instead of studying economic reports or interest rate decisions, technical analysts focus on price itself. They look at historical price movements to identify patterns, trends, and levels that may help explain what markets are likely to do next. It does not predict the future. Nothing does. What it does is help traders think in terms of probabilities rather than gut feelings. The approach has been around for well over a century. Charles Dow, co-founder of the Wall Street Journal, laid much of the groundwork in the late 1800s. Traders and researchers have been building on those ideas ever since. Technical analysis rests on three core assumptions. First, price reflects everything. The idea is that all available information, economic data, news, market sentiment, is already baked into the current price. Second, prices move in trends. Markets tend to move in one direction for a period before reversing or stalling. Identifying that direction early is one of the main goals. Third, history tends to repeat itself. Because human psychology drives markets, similar situations tend to produce similar reactions, which is why certain chart patterns keep appearing across different markets and different time periods. The tools most beginners start with are support and resistance levels, trend lines, and a handful of indicators. Support is a price level where buying tends to emerge. Resistance is where selling pressure tends to appear. These levels help traders decide where to enter a trade, where to place a stop loss, and where to take profit. Trend lines map the direction of the market visually. Indicators like moving averages, the RSI, and the MACD add context. They do not give perfect signals, but they can sharpen your read on the market when used alongside other analysis. Chart patterns are another layer. Continuation patterns, flags, pennants, triangles, suggest a trend is likely to keep going. Reversal patterns, head and shoulders, double tops, double bottoms, suggest a trend may be turning. No pattern works every time. A textbook setup can still fail. That is why stop-loss orders are not optional. They are essential. Many traders combine technical analysis with fundamental analysis, using economic data for the bigger picture and charts for precise entry and exit points. Neither approach is better. It depends on your style and how you prefer to work. If you want to start building these skills, focus on one or two tools at a time. Draw support and resistance on historical charts. Watch how a moving average behaves across different conditions. A demo account lets you do all of this without risking real money, and that is the right place to start.